Hi everyone. Today we are going to be talking about a question that comes up a lot, and there was actually just an article published on the Wall Street Journal about this, and it is tax loss harvesting. And the reason this is so timely that Michael and I want to talk about this is we had a client just write us another email about this today, and he actually said, Michael, can you explain this to me like I'm an 8th grader? And I'm going to go a step further and say, Michael, can you explain this to me like I'm a 5th grader? I want to be on the show, Are You Smarter Than a 5th Grader? I want to be able to answer this question. So what is tax loss harvesting?
Tax loss harvesting basically represents when we buy an investment, okay, one of two things is going to happen. It's going to go up or it's going to go down. When we sell that investment, it's either going to be at a gain or at a loss. And the tax implications are going to depend on how long you held that and whether you sold it at a gain or a loss. So for example, long-term is considered by the IRS 365 days since you bought that investment.
Okay.
If you've held it for over 365 days and you sell it, it's either going to be a long-term capital gain or a short-term capital loss, okay? Long-term capital gains are valuable because they're taxed at favorable tax rates. They're called capital gains rates. We sell it in under 365 days, then we have potentially a short-term capital gain that's taxed at less friendly earned income rates. So those are the things we want to be aware of. Now, losses, when we think about investing, are great. We're not aiming for that, but it's not a total loss because from a tax standpoint, if we have an investment that we bought that went down in value, we can harvest that loss. So that's what tax loss harvesting means. And with a sale of a investment that's gone down in value, there's multiple benefits. One, we can take up to $3,000 of that loss and use it to offset earned income from other sources. Right. Or we can use that loss to offset capital gains. And so last thing I would say about that, I'm trying to think about how to make this as simple as possible. Once we've used up losses to offset the gains, we can carry forward any additional losses to offset future gains indefinitely. So while there's a lot going on there, really what we're just talking about is, after we bought it, when we sell it, do we have a gain, do we have a loss, and then how does this net across all of our investments?
Now, is tax loss harvesting, is it specific to certain accounts? Like, would you do that in my IRA, or is this just specific for brokerage accounts, 401ks? What would you say?
Great question. Retirement accounts, IRAs, 401ks, Roth IRAs, we can buy and sell. We're not going to do any tax implications, gain, loss. This is only for taxable accounts.
And why doesn't it apply to IRAs or 401ks?
Tax deferred.
Tax deferred.
Yeah, we can collect income in those accounts. We can realize gains. We don't have to pay taxes on them.
So this is just taxable accounts, brokerage accounts.
Correct.
Tax loss harvesting is only for those accounts in the year that you would incur that tax.
Exactly.
Okay. So let's talk about timing, because I know that timing matters for this, and that there's also something called default settings, maybe at Schwab, Fidelity, Vanguard. What's that all about?
Yes. So timing on this, really there's multiple things that we would want to look at. We're towards year end. And so when we buy or sell a security, we're going to be tax implications are going to apply to the year that occurs. So, this is a year where almost all investments are up. You have a lot of capital losses in your portfolio this year, give us a call. We can probably help with that.
Yeah.
But you can strategically decide, hey, I'm going to sell investments at a loss. Maybe you could rebuy those in the future, but realize those losses. Now, the question on the default settings, and this was the main focus on the article in the Wall Street Journal, is that a lot of the largest broker-dealers will just default unless you direct them otherwise to what's called FIFO, first in, first out, LIFO, last in, first out, HIFO, highest in, first out. These acronyms, we don't need to get into the weeds on that, but what might happen if you just default into which tax lots you're going to sell? You might sell shares that are at a short-term capital gain when you could have sold shares that are at a long-term capital gain.
So really that could have made me pay more. You have to be really careful.
You could pay more and you could realize less valuable losses.
Yeah.
So in both instances, it could work against you. And so, what we utilize is software that we call Tax Loss Optimizer. And what that's going to do systematically is anytime we have a sale of a security, we're going to sell shares at a short-term capital loss, then a long-term capital loss, then a long-term capital gain, then a short-term capital gain.
That's the order you want to do it in.
That's the order you want to do it in, because that's going to pull forward any of the most valuable losses and defer, any of the short-term gains, which are going to be taxed at less favorable tax rates. At the end of the year, all your buys and sells are going to be netted against each other from a capital gains and loss standpoint. But if you're strategic about it and do it systematically, you can compound your money at a higher rate because you're realizing less in taxes.
Yeah. And if you're a good wealth manager, you are taking advantage of this tax loss harvesting. This is a very, very important thing to ask your advisor if they are doing this for you. So I would like to switch topics if you are ready to switch, Mike, and talk about wash sales.
Okay.
What are wash sales? Because this is another thing that we get a lot of questions about from our clients about wash sales. What are the rules around them and why do we care?
Right, we're going to run your stocks through the laundry.
Yeah.
Not quite. Wash sales basically represent, there's a window, 30 days on either side of the transaction where, I'll just give you an example. Let's say that we bought an investment and then we're going to sell it. If we buy a substantially similar investment 30 days prior to that sale or 30 days after that sale, it's a 61-day window. It's called a wash sale. The IRS says, hey, you bought shares in Google, A shares, and then you sold them and then repurchased them in C shares the next day. That's a substantially similar security. You really didn't sell it. You still maintain exposure. So what happens is that loss gets added onto the cost basis when you bought it. Okay. Eventually you can realize it, but it's not something that you want to do because you could have realized the loss and maybe bought something different. Similar, but different enough, for instance, an exchange traded fund in the similar sector, and avoided the wash sale entirely.
So are you saying if I own Coke and I want to sell Coca-Cola, I could buy Pepsi?
Exactly.
And that would not
That's different
create
enough.
a wash sale?
Right,
Okay.
correct.
Okay, I like it. Okay, so what should someone watching this ask their advisor to make sure they're doing it right?
Great question. So I think the first thing that I would ask is, what is your system for selecting tax lots?
Okay.
Are you using FIFO, LIFO? Can we change that? Why
don't you explain what is FIFO and LIFO?
Okay, so FIFO is an acronym. It stands for first in, first out.
FIFO.
And basically what that does is that, when you buy a security, you may be reinvesting dividends, you may have subsequent purchases over the years. It's going to sell the first ones that were bought. Well, in a rising market, you might be selling the ones with the lowest cost basis generating the highest gain. That is the default at Charles Schwab. Okay, so this is something that you would want to be aware of. LIFO is the opposite. We're selling the last in, first out. Okay, so the last purchase that we had is the one that we're going to sell. In a rising market, that may be the highest cost basis stock generating the smallest gain, but we might have bought that in under a year, and that's subject to short-term capital gains rates. So that's not always optimal either. And then there's another setting called HIFO, another acronym, which is highest in, first out, and that is going to select the tax lot with the highest cost basis. But again, it's not going to pay attention to when that security was bought. It could be subject to short-term capital gains. And so these default settings aren't great. So that's one thing that I would ask. Another is, what is your tax loss harvesting strategy? Okay, if I buy something, if I'm managing 1,000 different client accounts, right? Clients are invested at different times of the year. They've held investments for different periods of time. You could hypothetically have a client that has the same strategy as another client, but might be trading at a loss for a certain position where another client might be at a gain. What is your process for systematically harvesting losses when they occur? Okay, and the final question that I would have is that there's an interplay between these tax loss harvesting strategies and other parts of our income, Social Security, pensions, wages, right? How are you monitoring the big picture, and what's going on with these transactions so that I'm optimizing, the taxes that I'm paying to make them as low as legally possible.
Yeah, you guys, this is so important. If you have an advisor that is not connecting the dots between your portfolio and your tax plan, you need to really start asking some serious questions because this is a big deal. So you told me a story earlier about a client who focused too much on avoiding taxes. Can you share that?
Yeah, that's a really good point, Jamie. And in this situation, this was back in 2018. It was in the fall. We do a retirement planning class, and these folks had attended this class, and we did a financial plan for them. And they realized they were way too aggressively invested, for what they wanted. Okay, 100% in stocks. They were retiring later that year, and it's like, oh my gosh, okay, we need to reduce our risk. This is in October of 2018. They decided that they wanted to wait until January of the next year to rebalance their portfolios to defer realized gains for a calendar year, right? In between when they made that decision and the end of the year, we had a nearly bear market. The NASDAQ index fell by almost 24%. S&P 500 fell by almost 20%. So in essence, in order to avoid paying what would have been net tax bill of $70,000, they exposed themselves in that time period to a $250,000 loss in their portfolio. So the taxes, play a role in deciding, what we're going to do with our portfolio. But again, don't let the tax tail wag the investment dog.
Oh, will you repeat that slogan? Because we use this a lot in meetings, and I think this is a great sentence. Go ahead.
Yeah,
and
don't let
that.
the tax tail wag the investment dog.
That's right.
So
That's right.
Taxes are part of the consideration that need to be paid when you're looking at your investments and what to do with your portfolio. But they're just a part. We need to look at, the big picture.
That's right. So the goal isn't just to minimize taxes. It's really a broader goal to maximize what you keep. And I think that is the bottom line of the discussion today, is just maximizing everything you keep. Taxes are very important, but they're not the whole picture.
Exactly.